Hello and welcome to Home Buying 101. My name is Jeff Eisenberg. I'm the broker owner of Southern Oaks Mortgage. I graduated from California State University in Northridge. I've been in the business for approximately 25 plus years. Previously worked at Bank of America as a preferred banking officer and a major accounts district manager for ADP Payroll Service. I now reside in Stevenson Ranch, California for the past 19 years, and I've been married 30 years and have 3 beautiful daughters, 19, 23, and 25. So today's agenda, we are going to talk about current market conditions. We're going to talk about the benefits of homeownership, the difference between renting versus owning, qualifying for a home purchase, what the loan estimate is, defining commonly misunderstood language of lending, so all the terminology, getting into a home with a low down payment and other low loan programs, and what to look for in a real estate agent. So let's talk for a second about current market conditions. Right now we have rising inflation. Rates and inflation follow each other. So if interest rates are up, inflation is up. Have that backwards. If inflation is up, interest rates are up. If inflation is down, interest rates typically go down. We have very low inventory, which is causing an increase in housing prices. So the lower the inventory, there's more buyers than there are sellers. So that's causing prices to go up as well. Rising interest rates and home affordability. So with inflation, obviously, we have rising interest rates, and that's going to limit what you're going to qualify for based on your payment and your debt to income ratio, which we'll talk about later. Also, first-time buyers and non-occupant co-borrowers are becoming more prevalent. So we're seeing a lot of first-time buyers and what is known as non-occupant co-borrowers. Those are people that co-sign with you but are not living in the property. They're just helping you qualify. And then recession is looming. So we are expecting a recession coming up, and with a recession typically interest rates will drop. Housing prices may level off and maybe even decline a little bit at that point. And then also the Fed is talking about, I'm sure you've heard on the news, they're talking about increasing the rates. When they talk about increasing the rates, they're talking about the Fed funds rate, the discount rate, and the prime rate. And these are all short-term rates, and the Fed funds and the discount rate are what banks lend to other banks overnight. The prime rate is what affects things like credit cards, car loans, any consumer debt. So the more the Fed raises those, the harder it's going to be to pay off some of those items like credit cards and so forth. All right, so let's talk about the median home prices in the Santa Clarita Valley. So back in December of 2017, condos, the average median price was $345,000. Now we'll look at homes in 2017. The average price was $580,000. Fast forward to March of 2022, condos now are going for around $605,000, and houses are going for around $850,000. So that's an increase of 75.4% on condos and an increase of 46.6% on homes. So overall, you can see that in just 5 years, owning a home has been very, very profitable for many people. So let's talk about the benefits of home ownership. You have tax deductions. When you buy a house, you can write off your property taxes and the interest that you pay on your mortgage. So that helps you out quite a bit, as well as you have security for the future. So as you can see from the previous slide, that owning a house gives you more security for the future because the chances are it's going to grow in value to a point that you'd be able to turn around and sell it and make a handsome profit. And it's a very sound investment. I've owned several homes over the years, and every house I've had has gone up in value, and I was able to, take that money and either buy another rental property or, put it in my account and let it grow interest in interest-bearing accounts and stocks, bonds, whatever I choose. So it's a very, very smart idea, I believe, to own a house versus renting. And then you have pride of homeownership. So what's nice about owning a home is you can do whatever you want typically to the house. It makes you feel better when someone says, hey, where do you live? Say, oh yeah, I own a house in Northridge, or I own a house in Santa Clarita, or I own a condo, whatever the case may be. It's a lot better than saying, oh no, I rent an apartment, or I'm renting a house. You get that pride of homeownership, and it really does make a difference. I guess you'd have to really own a house to really get that feeling, but it really is a good feeling. Okay, so let's talk really quickly about credit scores and what they mean. So credit scores range from 350 to 850, and scores are comprised of many, many different factors. So here's a breakdown of what the scores mean. So 35% of your credit score is your payment history, good or bad. The 30%, the yellow section, is the amount that you owe on your credit cards. The pink is length of credit history. The 15% is how long you've had credit history. The longer you have it, the better your score will be. The blue is types of credit. So you have consumer credit, you have mortgage credit, auto. There's a whole bunch of different kinds of credit types that you will receive over the years. And then the green is 10%, which is new credit. So how much new credit do you have versus the old credit, and so forth. So those are what comprises the credit scores. Okay, so here's how a lender looks at credit scores. So assuming you have a 740 plus FICO score, that's the best you could have. It's an A plus 5. You're doing really well, and you'll get the best rate at a 740 or above. When you're between 720 and 739, you're very good as well, but there will be a difference. You won't get the best rate that you could get if you had 740 plus. 700 to 719, you're A plus 3. 680 to 699, A plus 2. 660 to 679, you're A plus. 640 to 659, you're A. 620 to 639 is your A minus. So you can do loans, conventional Fannie Mae, Freddie Mac type loans, when your FICO is as low as 620. But once you go below 620, then you're talking, let's say 6 to 619, A double minus, you're going to have to go to an alternative type of loan, different kinds of lenders. FHA is a loan that allows you to go to lower FICO scores, which I'll talk about in a little bit. And then anything below the 600 mark, you're looking at hard money. You're talking B and D credit, and that's where you're going to really pay a lot of money to get the loan and also have to put a lot more money down. Okay, so now let's look at rent versus owning over a 5-year comparison. So let's assume you're renting, and you're renting at approximately $3,000 a month, and every year they increase your rent by 5%. Your total rent over those 5 years would be $198,922. Okay, now let's say you bought a house for $605, or a condo, and you put 3.5% down, so you did an FHA loan. Your loan amount would be $594,041. Your interest rate, assuming today's rates, you'd be at 4.25%. Your monthly payment, including PITI, which stands for principal, interest, taxes, and insurance, would be $4,016.07. But when you tally up those payments over the course of 5 years, you only are at $195,031, because you also get the tax break. So assuming you're in a 28% tax bracket, you're actually going to be getting a tax break, which makes those payments lower. So the balance on your mortgage is going to be $539,434 over those 5 years. So you've already paid your mortgage down in that time. You have more equity. So not only do you pay less overall in your payments, but now you have equity growing in the house that you own, where when you rent, you're basically paying your landlord, and your landlord's getting rich off of you. So it does make a difference. So right there you have $54,606 that you've been paying towards principal. So the money when you own a house is going to you. It's going to your equity in the house, versus when you have rent, it's not going to you, it's going to your landlord. Okay, so let's look at this example again. So the benefits of owning your home, and this is from the previous example. On that $605,000 purchase on the previous slide, you're going to be paying $630.21 per month for property taxes. The interest on your loan is $2,103.90 per month. So the tax savings is $765.55 per month, which makes that net effective payment only $32.50.52 from the $44,016 on the previous slide, if you're in a 28% in tax bracket. So owning a house really does make a difference. Okay, so now let's talk about qualifying and what a lender is analyzing when they look at your qualifying. Income is the most important, of course. They're basically looking at your income to housing expense ratio. This is your PITI, principal, interest, taxes, insurance, known as your housing expense, and they're going to divide that by your gross monthly income, which is called your front end ratio. Now, when I say monthly gross income, that's before taxes are taken out. So if you make $60,000 a year, I'm taking $60,000 divided by 12 and dividing it by what your new housing expense, or your new housing expense divided by your monthly gross income. All right, so let's look at an example. Here's Mr. Jones. Loan amount $594,041 from the previous example. Interest rate at 4.25. The PITI is $4,016. His gross monthly income is $10,000, so he makes $120,000 a year. So to figure out his front end ratio, you would take the PITI divided by his gross monthly income, and he's at a 40% front end ratio. Now the most important ratio is this one, which is the income to total debt ratio. And this is basically taking the PITI, the $4,016, plus all other monthly obligations, dividing it by your gross income. And what I mean by all other obligations, that's car loans, minimum payments on credit cards, student loans, any other kind of loans you've taken out. And that's known as your back end ratio, and that's the most important. Usually cannot go above 50%. So let's get an example. Mr. Jones, same scenario, PITI is $4,016, other monthly debts, let's say he has $550, maybe a car loan and a couple credit cards. His total debt is $4566. We're going to take that $4566 and divide it by that same $10,000 in income he makes, and you're at a 46% back end ratio. And that's fine because you can go up to 50 in order to qualify. Okay, so why would you want to pre-qualify? Well, most important is to know where you stand, what your payment's going to be, and the money you're going to need to close. A lot of people don't realize, but you've really got to figure this out before you go out and look, because just because you can qualify for a $1 million house or a $800,000 house doesn't mean you want to do that, because you have to look at what the payment's going to be, and are you going to be able to afford that big payment, and you have to figure that out ahead of time. Also, the seller's acceptance of your offer increases the chances of your offer getting accepted, because they know you're already pre-qualified. And then also, it's a much smoother escrow process, less uncertainty, less time. We can close a lot faster and get things done a lot easier if you are pre-qualified. I prefer you get pre-approved, which is one step further than pre-qualifying. It's actually running the credit, making sure that everything fits in line, looking at your tax returns, pay stubs, W-2s, everything to make sure you're good to go. Okay, so now we're going to go over some terminology. What's the loan estimate? Used to be called the good faith estimate. But this is an itemization of estimated fees and charges required to close your loan. So it's a list of all the different fees that are going to be needed. Loan origination fee, which is also known as points. This is actually a one-time charge by the investor, which is the lender, which adjusts the yield, which is the interest rate, on the loan to what the market conditions demand. So you are the market. You can choose to get a higher rate, a lower rate. The higher rate you go, the more the lender will give you money back towards your closing costs. The lower the rate is, the less you'll get back, and sometimes if you want to pay points, you can pay points to buy down the rate to even lower. Each point is equal to 1% of the mortgage amount. So for example, 1 point of $650,000 loan is $6,500, 1%. So keep in mind, most of the time it does not pay to pay points. And you can always call me afterwards, and I can explain that to you. But it's really not the wisest thing in most circumstances to pay origination fee, because you don't recuperate the cost of it in the amount of time that makes sense. Okay, appraisal fee. This is a fee that pays for the statement of the property value prepared by an independent property appraiser. Appraisers now work for appraisal management companies, or what we call AMCs. The lender picks which AMC they want to work with, and then the AMC randomly chooses the appraiser. I kind of look at it as a dartboard. Basically, they take a dart and they throw it at this board, and that's the appraiser you end up getting. So you can't choose the appraiser like you could back in the pre-debacle period of the mortgage industry, back pre-2009. And the cost of an appraisal, depending on the lender, will be anywhere from $475 to $750. Credit report fee. Okay, this is a fee that covers the cost of a credit report, which details your payment history with previous and past creditors. This is a different credit score than you will get if you look at Credit Karma, or your bank sends you, Discover Card, or your bank sends you a credit report or a credit score. This is completely different. A mortgage credit report is very different from pre-approval for a credit card or pre-approval for an auto loan. There's about 40 different credit scoring models, and the most stringent one is the mortgage credit report. Has the toughest on your criteria on your score. So keep that in mind, that if you see a score on Credit Karma, it's not necessarily going to be that when we run it for a mortgage. And the cost of that is usually between $34 and $60, depending on what company you're using. Okay. Now, prepaid interest. This is paid at the settlement, the close. It's a charge that represents the interest that accrues on the mortgage from the date of closing to the first regular monthly payment. So in other words, if you close in the month of June, let's say the 15th of June, you're going to prepay interest from June 15th to the end of June. Your first payment is not going to be July 1st. Your first payment is going to be August 1st. So you're always prepaying the interest, and mortgages are always in the rears, meaning when you make your July 1 payment, it's actually the interest that accrued in June. And when you make your August 1st payment, it's the interest that accrued in July. Okay, mortgage insurance. This is typical, a fee that's charged to the borrower, to you, which it basically is, it pays for the insurance that protects the lender's interest. Now, key word here is the lender's interest when the loan is over 80% of the value of the property. Doesn't protect your interest, it protects the lender's interest. So if you're putting down less than 20%, the lender will force you to get this insurance that protects them, because in case you don't pay or you foreclose, they get paid back by having this insurance that you're paying for them. So keep that in mind. And there's now a way to avoid mortgage insurance using what's called LPMI, lender paid mortgage insurance. or structuring your financing as an 80-10-10. So an 80% first mortgage, a 10% second mortgage, and then you putting 10% down. Now LPMI, you will pay a little bit higher interest rate, but you will not have a monthly mortgage insurance fee. And that's something that I can discuss with you individually if you're interested. Okay, now this cost, of course, is determined according to the loan amount. So whether you're, the higher the loan amount, the higher the mortgage insurance will be. It's also known as PMI, private mortgage insurance. Okay, tax insurance impounds. These are funds held in an account by the lender to assure future payments of your property taxes, your hazard insurance, which is your homeowner's insurance, and mortgage insurance. The lender determines the amount that must be placed in reserve in order to pay the next insurance premium when due or specific monthly payments for property taxes. It's often referred to as an escrow account. So basically the lender will set aside this money and it sits in an account for you. It's like a bucket, and every month you're paying a portion of your taxes, a portion of your insurance, and it goes into these buckets. And then when your taxes are due twice a year, they pull it out and they pay it for you. So you're not behind and you don't have to pay it yourself. It's coming out of your monthly mortgage payment. Okay, now let's talk about reserves. So this is money that you must have in your account. Typically the lender requires 2 months of your new housing expense as reserve. So we talked about the PITI 4016 in the previous example. Having 2 months of that, you'd be at 8,032 you'd have to have in the bank account if the lender is requiring you to have 2 months of reserves. Most of the loans that we do not require reserves. So you do not have to have reserves, especially FHA, they do not require reserves. But if you own any rental properties, you do have to have 6 months of reserves on any rental property that you own in the bank. So if you have a rental property that the principal, interest, tax, and insurance is $3,000, you're going to need 6 months, which is $18,000, sitting in the bank or in stocks or some kind of retirement or something you have to have as showing reserves for each of your rental properties if you own any. Okay, homeowners insurance, also known as hazard insurance. This is required insurance that covers the cost to rebuild the house in the event of fire or total destruction of the home. Earthquake insurance is an additional cost, but not typically required by the lender. This typically is 1/4% of the loan amount. Now, depending on the loan amount, if it's a small loan amount, it could actually be a little bit more than 1/4%, but that's a good estimate to determine how much your homeowner's insurance is going to cost, is just taking the loan amount, multiplying it by 1/4%. Escrow settlement fee. This fee is paid to escrow as an administrative cost for ensuring the proper and, very important, unbiased execution of the transaction as instructed by all parties. So when you go into escrow, you buy a house, you fill out a residential purchase agreement, and the escrow officer follows that agreement to the T. They're supposed to. They're not supposed to be biased towards the buyer or the seller or any of the agents. They're supposed to just follow what the contract says. And this fee is usually $2 per thousand of the purchase price plus a fee of $350. It varies depending on where you're buying, and each escrow company can charge a little bit different. Title insurance. Title insurance is a one-time premium charged at settlement at the close that protects a lender and or the borrower against losses due to title defects. So what that basically means is, let's say you are buying a house and the previous owner had a roofing contractor come and repair the roof, but the seller didn't pay him the money that he owed him to do the roof. So what happens is the contractor files what's called a mechanic lien on the house, and that actually now clouds the title to the property, which means you can't purchase it and have it go directly into your name. it's going to cloud the title. It's like there's a problem on the title and it has to be cleared up before we can close escrow. And that's what title insurance does, is it clears up any title defects and makes sure that when you take over this house, it is free and clear from any encumbrances. And there's your example. It's either a federal tax lien, mechanics lien. Those are things that could cloud title. So why should you use a mortgage broker versus a banker? So let's talk about that for a second. Okay, so basically a mortgage broker, when you're talking about representation, a mortgage broker, banker represents you by packaging your loan and highlighting your strengths and minimizing your weaknesses. We try to make your file look beautiful when we submit it to an underwriter. Whereas the bank represents the bank, and they don't really highlight anything. They just submit it the way it is and hope that it gets approved and ready to go. Customization. Mortgage broker, banker usually offers a wide range of programs with the most competitive adjustable and fixed rates, where a bank only offers a very limited amount of programs. It has to fit inside their box. Flexibility. A problem loan with a mortgage broker can quickly be moved from one lender to the next. We just take the whole file and move it to another lender overnight, very fast. If your file gets declined at a bank, you have to start the whole process over somewhere else. They don't just move it somewhere else. It's basically, it gets declined and you have to start the whole process over again. Availability. Typical mortgage brokers tend to work 24/7. I know I do. So brokers work weekends and evenings. I get calls all the time on the weekends and the evenings, early mornings, you name it, where banks, typically, they work bankers' hours. Professionalism. Brokers are familiar with many lenders and loan programs, and we're also licensed by the Department of Real Estate. And that's a big, important aspect of being a mortgage broker, is that we follow the Department of Real Estate rules and regulations, whereas a bank, they only are familiar with a limited number of programs, and they are not required to be licensed. They are when you work with a banker, they're licensed through the CRMLA, which is different, and that's they don't have to go to special classes and schooling to get their licenses and take a test every 4 years like mortgage broker does. Performance. Generally, we get paid on commission, and therefore we're very motivated to close your deal, because if we don't close it, we don't get paid. Whereas a banker, they're generally paid a base plus a lower commission. So whether they close your loan or they don't, they're still getting paid. So there's no real incentive to help push your loan along a lot faster and make it happen. So another thing is costs. Mortgage brokers can offer numerous rates and fee combinations, whereas the bank, of course, like I said, is in a box and can only offer what's in their box, and that's it. Okay, what's the difference between fixed and adjustable rates? So fixed stays fixed for the term of the loan. The risk of future interest rate hikes are eliminated, completely gone, because if it's fixed at 5%, you're at 5%. Very consistent payment. You know what you're getting yourself into when you do a fixed rate. Now let's look at adjustable. Notice I put it in red. Changes with the market. So market changes, adjustable rate can change with the market as well, can go up or down. The risk is far greater on an adjustable than it is on a fixed. The payment can constantly change. So depending on certain aspects of the adjustable, it can change every 6 months, it can change once a year, and the changes are capped out of what they can go up to, but it's just much more risky than, of course, a fixed rate. And the amount of times and the adjustment are agreed upon at the inception. So when you get an adjustable rate, the adjustment period is already calculated and figured out at the time of inception. So you know it's going to change every 6 months, every year, whatever the case may be. But here's the thing. Notice I put that in green. With risk comes high reward sometimes. So sometimes you can save thousands of dollars by going with an adjustable. And there's many different types of adjustables as well. So, definitely talk this over with whoever you're going to do your loan with and decide which way is the best way for you. So let's talk for a second about FHA loans. So what's nice about an FHA, it only requires 3.5% down and can be completely given to you as a gift. So the gift funds are allowed 100% on FHA. You can have a non-occupant co-borrower. So that means you can have a mom, a dad, a relative co-sign for you, but not live in the property and still consider it a primary residence. Minimum FICO score for an FHA is 540. Of course, you don't want to have a 540 FICO score. It'll be a lot, the cost and the rates will be higher and everything, but it's not the ideal situation. But if you need to get a loan, you can go in FHA and still get one. Maximum loan amount right now on FHA is $970,800. That's a huge amount. So, but I don't recommend going up to that. But if you had to, that's the maximum that you can go up to. The seller can pay all your closing costs and prepaids on an FHA, so it can completely be paid for all by the seller. In the market we're in now, sellers aren't paying any closing costs, so really can't help you in that respect. But if the market shifts a little bit, then the sellers will be more likely to pay some of the closing costs. Bankruptcy is okay after 2 years on an FHA and 3 years after a foreclosure, where a normal conventional Freddie, Fannie Mae type loan, bankruptcy after 4 and a foreclosure after 7. So FHA allows you to purchase and do things a lot sooner than a regular conventional loan. And then if it's a condo or a townhome, the complex has to be FHA approved. So that can hinder you sometimes because a lot of complexes are not FHA approved, and FHA has come in and did not renew a lot of their approvals at a lot of condo and townhome complexes. So that's a very important aspect that you just need to check with your mortgage broker before you purchase to make sure that you still be able to do it in a particular complex. And then your debt to income ratio can go above 50% depending on any compensating factors. Compensating factors are things like your excellent credit history, long time on the job, having a lot of reserves in your assets or 401k. Those are all compensating factors that will allow you to go above 50% on your debt to income ratio. Okay, what to look for in a real estate agent. First and foremost, you should realize you're always better off having an agent working for you than not working for you. After meeting with them, you should feel comfortable with their ability to find you a home. So, first impressions are important. So if you meet with them and you feel comfortable with their knowledge and their ability, then that's a good sign. And realize that you're not paying the real estate agent, the seller is paying them. As a buyer, you do not have to pay for a real estate agent, so it's always better to have one than not have one. They should try to get to know you, your likes and your dislikes. So they should be asking you a lot of questions. Do you like, big backyards? Do you have dogs or pets or cats, whatever the case may be? Are you planning to have, kids? These are all things that they need to know so they can help you find the right house and make sure that, do you want a big master bedroom? Do you care about the flooring? Do you care if the house is carpet? Do you care if there's a pool? They need to know these things in order to give you and to find you the best house for you. So make sure that those are things that they ask you, and they should be very, very knowledgeable about all these things and ask you lots of questions. And then finding a home on your own is frivolous. An agent can arrange a map tour of all the homes that are available in your price range. A lot of people think they could just go onto Zillow and Trulia or Redfin and find a house and it's all fine and dandy, but that's really not true because first off, Zillow Redfin, all those online companies are pulling the information from the MLS, which the realtors get first. So the realtors are the first line in getting all the information, and then it also takes time once a realtor puts something in the MLS for it to actually go into the online system. So Zillow might say a house is still available, but when you go on the MLS, it's already sold. And you won't know that if you're not working with a realtor. You're just going straight to Zillow. So keep that in mind. And then an experienced agent will require you to get pre-qualified with a mortgage professional prior to showing you homes. Don't expect a good agent to want to work with you if they haven't gotten you pre-qualified or pre-approved ahead of time. So keep that in mind.
Well, thank you for listening and happy house hunting. Hope you enjoyed this informational slideshow. For more information or any questions, please feel free to reach out via email at jeff@somloans.com or call my office at 661-964-2600. I'd be more than happy to even help you with your financing. I'm a California broker and can finance any property in California. You can also leave any questions or comments below. And if you are interested in getting a copy of my free book, please shoot me an email, and may your dream of a home be reality.